Welcome to this ultimate guide on personal finance. In this video, you'll learn the 5 key pillars of financial success: budgeting, saving, debt management, investing, and building long-term wealth. Whether you're just starting out or looking to level up your finances, this video is for you. We'll cover everything from creating a budget that works to investing in real estate and building a diversified portfolio. I'll share practical tips, actionable strategies, and real-world examples to help you make smart financial decisions. Remember, personal finance is 20% knowledge and 80% behavior. So, get ready to take notes, get inspired, and most importantly, take action. The first step to mastering your money is understanding where it's going. That's where budgeting comes in. Now, I know what you're thinking. Budgets are restrictive and boring, but trust me, a well-structured budget is your roadmap to financial freedom. It allows you to track your income and expenses, identify areas where you can cut back, and allocate more money towards your financial goals. Start by listing out all your sources of income and then track your expenses for a month. You can use a budgeting app, a spreadsheet, or even just a notebook. The key is to be consistent and honest with yourself about your spending habits. Once you have a clear picture of your cash flow, you can start creating your budget. There are different budgeting methods out there, but one popular approach is the 50/30/20 rule. This rule suggests allocating 50% of your after-tax income towards needs, 30% towards wants, and 20% towards savings and debt repayment. Needs are your essential expenses like housing, groceries, transportation, and utilities. Wants are things you enjoy but could live without, like dining out, entertainment, and travel. And finally, savings and debt repayment include contributions to your emergency fund, retirement accounts, and paying down any outstanding debts. Now let's talk about saving. The golden rule of personal finance is to pay yourself first. Before you even think about spending money on anything else, set aside a portion of your income for savings. Automate this process by setting up automatic transfers from your checking account to your savings account each month. A good rule of thumb is to have at least 3 to 6 months' worth of living expenses in an emergency fund. This will provide a financial cushion in case of unexpected events like job loss or medical emergencies. Remember, building wealth is a marathon, not a sprint. By consistently budgeting, saving, and making smart financial decisions, you'll be well on your way to achieving your financial goals. Debt can be a powerful tool when used responsibly, but it can also be a major financial burden if mismanaged. The key is to understand the difference between good debt and bad debt. Good debt typically refers to loans that help you build wealth or increase your earning potential over time. This includes mortgages, student loans, to some extent, and business loans. Bad debt, on the other hand, is debt that doesn't really add any value to your life and often comes with high interest rates. Think credit card debt, payday loans, and car loans for depreciating assets. If you're struggling with high-interest debt, your priority should be to pay it down as quickly as possible. One effective strategy is the debt snowball method, where you focus on paying off your smallest debt first while making minimum payments on all other debts. Once the smallest debt is paid off, you roll that payment amount into the next smallest debt, and so on. This method helps you build momentum and stay motivated as you see your debts disappear one by one. Another important aspect of managing your finances is understanding your credit score. Your credit score is a numerical representation of your creditworthiness, and it plays a crucial role in your ability to secure loans, rent an apartment, and even get a job. To build a good credit score, pay your bills on time, keep your credit utilization low, the amount of credit you're using compared to your total credit limit, and avoid opening too many new credit accounts in a short period. You can check your credit report for free from all 3 credit bureaus, Equifax, Experian, and TransUnion, once a year at annualcreditreport.com. By managing your debt responsibly and maintaining a good credit score, you'll unlock better financial opportunities and save money on interest payments in the long run. Retirement might seem like a lifetime away, but the earlier you start planning, the better. The power of compound interest is on your side, and even small contributions made consistently over time can grow into a significant nest egg. The first step is to choose the right retirement account. If your employer offers a 401k plan, take advantage of it, especially if they offer employer matching contributions. It's essentially free money. If you're self-employed or your employer doesn't offer a retirement plan, consider opening an individual retirement account, or IRA. There are two main types of IRAs, traditional and Roth. With a traditional IRA, your contributions may be tax-deductible, and your earnings grow tax-deferred until retirement. With a Roth IRA, your contributions aren't tax-deductible, but your earnings grow tax-free, and you don't pay taxes on qualified withdrawals in retirement. Once you've chosen your retirement account, it's time to start investing. A target date retirement fund is a good option for hands-off investors. These funds automatically adjust their asset allocation as you get closer to retirement. If you prefer a more hands-on approach, you can create your own diversified portfolio of stocks, bonds, and other asset classes. Remember, investing involves risk, and there's no guarantee of returns. However, by investing consistently over the long term, you're more likely to ride out market fluctuations and come out ahead. Don't forget to regularly review and rebalance your retirement portfolio as needed to ensure it aligns with your risk tolerance and time horizon. Life is full of unexpected events, and it's important to be prepared for the unexpected. That's where insurance comes in. Insurance is essentially a safety net that protects you and your loved ones from financial hardship in case of an accident, illness, or other unforeseen circumstances. There are various types of insurance, but some of the most essential ones include health insurance, auto insurance, renters or homeowners insurance, and life insurance. Health insurance protects you from potentially devastating medical expenses. Auto insurance is required by law in most states and covers damages or injuries caused by a car accident. Renters or homeowners insurance protects your belongings and provides liability coverage in case someone is injured on your property. Life insurance provides financial protection for your dependents in case of your death. It can help cover living expenses, mortgage payments, and education costs. When choosing insurance policies, it's important to shop around, compare quotes from different insurers, and choose coverage that aligns with your needs and budget. Don't be afraid to ask questions and negotiate better rates. Remember, insurance is not about getting rich. It's about protecting what you've worked hard for and ensuring that you and your loved ones are financially secure, no matter what life throws your way. Taxes are an inevitable part of life, but there are legal and ethical ways to minimize your tax burden and keep more of your hard-earned money. Tax planning is not just for the wealthy, it's a smart financial practice for everyone. The first step is to understand the different types of taxes you're subject to, such as income tax, property tax, and sales tax. Next, familiarize yourself with common tax deductions and credits that you may be eligible for. For example, if you're a homeowner, you can deduct mortgage interest and property taxes. If you have student loans, you may be able to deduct student loan interest. And if you've made charitable contributions, you can deduct those as well. Another important aspect of tax planning is choosing the right investment accounts. As mentioned earlier, contributions to traditional IRAs and 401(k)s may be tax deductible, which can lower your taxable income in the present. Roth IRAs, on the other hand, offer tax-free withdrawals in retirement. It's also crucial to stay informed about any changes in tax laws. Tax laws can be complex and constantly evolving, so it's a good idea to consult with a qualified tax professional who can provide personalized advice based on your individual financial situation. Remember, tax avoidance is legal and encouraged, while tax evasion is illegal. By planning ahead, taking advantage of available deductions and credits, and making informed financial decisions, you can optimize your tax strategy and keep more of your money working for you. Congratulations! You've now been introduced to the 5 key pillars of personal finance. By implementing the strategies outlined in this video, you're well on your way to achieving your financial goals. Remember, personal finance is a journey, not a destination. There will be ups and downs along the way, but the key is to stay informed, stay disciplined, and stay focused on your long-term goals. Don't be afraid to seek help from financial professionals when needed, and continue learning and growing your financial knowledge. By the end of this video, you'll have a clear roadmap to take control of your finances and build long-term wealth. Stay tuned and let's dive in.